Carbon accounting is a technique used to measure and track how much greenhouse gas (GHG) an organization emits. GHG emissions are the main cause of climate change, and they need to be reduced to avoid its worst impacts. Carbon accounting can help organizations understand their contribution to climate change and take actions to lower their emissions. Carbon accounting can also be used to track projects or actions that reduce emissions in sectors such as forestry or renewable energy. For example, planting trees can sequester carbon dioxide from the atmosphere, while generating electricity from solar panels can avoid burning fossil fuels. Carbon accounting can quantify the benefits of these activities and help organizations earn carbon credits that can be sold or traded in the market. There are different methods and standards for carbon accounting, depending on the purpose and scope of the analysis. One of the most widely used frameworks is the Greenhouse Gas Protocol, which divides emissions into 3 categories: Scope 1, 2, and 3. Scope 1 covers direct emissions from an organization's own operations, such as fuel combustion or refrigerant leakage. Scope 2 covers indirect emissions from the electricity purchased by the organization. Scope 3 covers other indirect emissions that occur in the value chain of the organization, such as those from suppliers, transportation, waste disposal, or product use. Carbon accounting is important for measuring and reducing GHG emissions from corporations for several reasons. First, it can help corporations comply with existing or future regulations that require them to report or limit their emissions. Second, it can help corporations identify opportunities for cost savings and efficiency improvements by reducing their energy consumption and waste generation. Third, it can help corporations enhance their reputation and brand value by demonstrating their environmental responsibility and leadership. Fourth, it can help corporations access new markets and sources of finance that favor low-carbon products and services. Fifth, it can help corporations align their strategies with the global goals of limiting warming to well below 2 degrees Celsius above pre-industrial levels, as agreed in the Paris Agreement. One of the major loopholes in carbon accounting is the assumption that burning wood for energy is carbon neutral, meaning that it does not add any net carbon dioxide to the atmosphere. This assumption is based on the idea that the carbon released from burning wood is balanced by the carbon absorbed by growing trees. However, this idea ignores several important factors that make burning wood for energy a source of greenhouse gas emissions and a threat to the climate. First, burning wood emits more carbon dioxide per unit of energy than burning coal or gas. According to a study by the European Academy's Science Advisory Council, burning wood pellets can emit up to twice as much carbon dioxide as coal and 50% more than gas per unit of electricity generated. This means that replacing coal or gas with wood pellets will increase the amount of carbon dioxide in the atmosphere in the short term, which is critical for avoiding dangerous levels of global warming. Second, harvesting trees for wood pellets reduces the carbon storage capacity of forests and releases carbon stored in soils and vegetation. Forests are natural carbon sinks that absorb and store carbon dioxide from the atmosphere through photosynthesis. When trees are cut down, they stop absorbing carbon and release some of the carbon they have stored over their lifetimes. Moreover, logging operations disturb the soil and vegetation, which also release carbon into the atmosphere. A study by the Natural Resources Defense Council estimated that harvesting trees for wood pellets in the southeastern U.S. could result in a net loss of 21 to 49 million metric tons of forest carbon storage by 2030. Third, regrowing trees takes time and is uncertain. The carbon accounting loophole assumes that any carbon released from burning wood will be recaptured by new trees planted or regrown naturally. However, this process can take decades or even centuries, depending on the type and age of the trees harvested, the management practices used, and the environmental conditions. In addition, there is no guarantee that the harvested forests will be replanted or allowed to regrow, especially in regions where there is high demand for land for agriculture or development. Furthermore, climate change itself poses a risk to forest regeneration, as it can alter precipitation patterns, increase droughts and fires, and introduce new pests and diseases. One example of how this loophole leads to inaccurate and misleading reporting of corporate emissions is the case of forest biomass, where burning wood is defined as a carbon-neutral event despite releasing megatons of carbon. Forest biomass refers to any organic material derived from trees, such as wood chips, sawdust, bark, branches, or whole logs. Forest biomass is often used to produce wood pellets, which are small cylindrical pieces of compressed wood that can be burned for heat or electricity. The global market for wood pellets has grown rapidly in recent years, driven by policies and subsidies that promote them as a renewable and low-carbon energy source. However, as explained above, burning wood pellets is not low-carbon or renewable at all. It emits more carbon dioxide than fossil fuels and reduces the ability of forests to sequester carbon. Yet, under current carbon accounting rules, these emissions are not counted or reported by the countries or companies that burn them. Instead, they are attributed to the countries or regions where the trees are harvested, which may have different or weaker climate commitments. This creates a perverse incentive for countries and companies to import wood pellets from other places and claim that they are reducing their emissions by switching from coal or gas to biomass. For instance, the European Union, EU, and the United Kingdom, UK, are the largest consumers of wood pellets in the world, importing millions of tons every year from countries such as the EU, Canada, Russia, Vietnam, and Malaysia. The EU and the UK have set ambitious targets for reducing their greenhouse gas emissions by 2030 and 2050, respectively. However, by relying on wood pellets to meet their renewable energy goals, they are effectively outsourcing their emissions to other countries and hiding them from their official accounts. According to a report by Chatham House, a think tank based in London, biomass accounted for about half of the EU's renewable energy consumption in 2016. If these emissions were fully accounted for, the EU's reported emissions would have been 7% higher in 2016. Another example is Japan and South Korea, which are also expanding their use of wood pellets to replace coal and nuclear power plants after the Fukushima disaster in 2011. Both countries have pledged to achieve net zero emissions by 2050 under the Paris Agreement. However, by importing wood pellets from countries such as Canada and Vietnam and burning them without counting their emissions, they are undermining their own climate goals and creating a false impression of progress. According to a report by Global Forest Watch, Japan's biomass imports increased by 58% between 2012 and 2019. If these emissions were fully accounted for, Japan's reported emissions would have been 4% higher in 2019. These examples show how the carbon accounting loophole for forest biomass leads to inaccurate and misleading reporting of corporate emissions and creates a false sense of achievement in reducing greenhouse gas emissions. By ignoring the real impacts of burning wood for energy on forests and climate change, this loophole undermines the credibility and effectiveness of global climate action and puts us further away from reaching our climate goals.